Good evening, everybody, and welcome to our third session in Getting Started. This is a Mid-Michigan Manifest Investing program, and we're sponsored by the Mid-Michigan chapter of Better Investing and Manifest Investing. My name is Ken Kabula. I'm the president of the Mid-Michigan chapter, and my good buddy Mark Robertson is the CEO and chairman and everything else that you can name of Manifest Investing. And together we've been entertaining and speaking to audiences in Better Investing and in Manifest Investing for the last 12 or 13 years. We really enjoy it. We hope you do too. And without further ado, let's get the disclaimer out of the way, Mark, okay?
Okay.
Wait, I meant to mention one more thing on the front page. I want to know if anybody has noticed what's above the Mackinac Bridge. I didn't get any comments on it. I didn't get any questions about it. And nobody has seemed to notice what you're looking at when you're looking right above the Mackinac Bridge. I think, if I'm not mistaken, that these are the Northern Lights. If you've never seen the Northern Lights, I will tell you, they are something. They are a sight that I can't describe, that I can't explain, but when you stand outside on a cool evening and look up in the sky and see the Northern Lights, it is one of the most beautiful things that I've ever seen in my entire life. I can remember doing this, Mark, with you and Wendy and my wife up north at a getaway that we were at. And it's just breathtaking, the way that these lights suddenly appear and dance around the sky for quite a while, usually for 15, 20 minutes or longer. And I think that's what you're seeing above the bridge right there.
Oh, most definitely.
Without further ado, then, let's get out our disclaimer out of the way. This is an educational demonstration. We are talking about real stocks in real time, especially tonight. We're going to name an awful lot of stocks. We're going to be talking about ideas. Folks, we think that novices need ideas. We think you need to build a database of 10 or 15 stocks that meet our beginning model. And I hope you've been singing it for the last 24 hours. The song is Up, Straight, and Parallel. And that's the kind of stocks that we would love for you novice investors to build into a group large enough to put into a portfolio, but more important, to have a list of 12 or 15 good, solid, up, straight, and parallel stocks to begin your analysis career with. It's awfully difficult, like I said, to read a book like Crime and Punishment before you learn how to really read, and it's awfully difficult to do a lot of SSGs on stocks that don't meet the basic model. Let's start with the primer stocks, and those are the ones where the lines are just absolutely up in the right upward direction, going uphill, and where they're as straight as they can possibly be, and where the graph of the sales is parallel to the graph of the earnings line. That's what we're looking for. We're not telling you to buy, hold, or sell anything. We think you are all bright enough to do your own analysis or to begin to do your own analysis. We're not the boss of you, and we are very pleased to help you become the boss of yourself. If you want a copy of the slide deck, send a comment to Mark or to myself. Those are our real email addresses, and both of us were answering questions and sending out things today for yesterday, and we'd be equally happy to do that for tomorrow. Next slide, Mark.
I just want to add one special disclaimer for tonight. We are going to be talking about the discovery of ideas and using stock screening techniques. I just want to underline and bold that the screening results are the start of an analysis process, not the end. So you always want to take any screening results and then put them through the typical gauntlet of taking a look at whether the company is suitable, doing all your fact checking, etc. Screening is just the start of the process.
This is my wife in the upper picture with me. And this is Mark's wife in the lower picture with him. I think they were at a Buc-ee's down on I-75 as they were moving towards Florida. These are our bios and our experience, and we've been around for a long enough period of time that we think we understand at least how we can get beginners started in investing, and we're both enthusiastic supporters of the investment club movement. We feel that it's a great way to learn, and it's a great way to invest, and it's a great way with very little pain to perhaps build yourself a nest egg that is meaningful.
All right, I can take this one, Ken. This is our full
Okay.
disclosure. Again, just making sure that you understand, we are going to be talking about companies like Value Line, Morningstar, a few other different options, including Manifest Investing, which is my company. It is a subscription research service. And the nutshell description is that we basically are trying to take the lessons of the modern investment club movement and give you the tools and resources for discovering stocks, studying stocks, and building and managing portfolios. And it's all web-based and right at your fingertips. I'm not going to read the slide to you, but we do think it's important to attempt to keep it simple. We do focus in, you're going to hear these two a lot, the return forecast and the quality are the two most important characteristics. We will be talking about that a lot tonight. We do firmly and fervently believe that anyone can do this. And with a little bit of patience and discipline, wonderful things are possible. I say this all the time. There are no guarantees in investing, but the stuff that is done by all of us in the modern investment club movement can improve your odds. So there's more information there if you want to come back to it. If you have any questions on this, send me an email. Go ahead, Ken.
Well, you all remember that we began the series by talking about George Nicholson and some of the concepts that he believed in fervently. The primary concept, the first concept, the first thing we talk about always is that you need to be a regular investor to become one of these better investing style of investors. That means that you give yourself a schedule and then you invest no matter what's happening in the market. You're not a market timer. You're not a speculator. You're investing. It could be on a monthly basis. It could be on a quarterly basis. It could even be on a twice or once a year basis. But the key is to do it on a schedule and to put money into the market in good times and in bad times. After all, you're not buying the stock market. You're buying individual stocks within the market, and the market might be doing one thing while an individual stock is doing something completely different. Keep that in mind as you begin to put a portfolio together. We focus on high quality growth stocks, especially as novice and beginning investors. We will get a little bit fancier with our investing as we gain experience. But in the beginning, we're asking you to focus on the model of up, straight, and parallel. Look for high quality, long-term, consistent growth in sales, and then look for earnings that back up those sales and that are growing at about the same rate as those sales are growing. Be prudent, shop patiently and diligently, and make sure that you're diversified. Don't buy everything in the tech sector. Don't buy everything in the energy sector. Stay away from putting your whole portfolio into consumer discretionary. Shop patiently and diligently, and don't be afraid of any stock if it meets our model. And again, for a novice investor, our model is up, straight, and parallel. Don't try to get fancy in your first year of investing. Stay with the basics, get used to the process, get used to doing an analysis, and then the more that you analyze, the more that you will be able to kind of bend the rules a little bit and get a little bit fancier as far as the things that you might consider for your portfolio. Mark, anything to add to that?
Yeah, we splashed a few images at you here. The one a beginner might want to take notice of is the book One Up on Wall Street by Peter Lynch. I wouldn't do it right as you get started, but after you've been doing it for a little while, great way to think about stuff. He includes warnings about some of the stocks Ken was just talking about to avoid. The Motley Fool Guide follows a very similar type mentality to investing. And then that third one there, The Intelligent Investor, that's not for you. That is one of the crime and punishment books. It's a great one, though, but only after you have a little bit of better understanding after you've been doing it maybe for a year or so. I will tell you, I've probably read that book, I want to say 5 or 6 times. So it's an excellent resource for investors, but maybe with a little bit of experience first.
This intelligent investor came out of the 50s with kind of the discovery of value investing, which led to the kind of investing that we do today, which is a combination of growth and value investing. And don't forget that the NAIC Investors Manual, and they're hanging around in different iterations on different used book sites. You can't get them from headquarters, at least not this one anymore, but there are a couple of investors manuals that you can pick up in different used book places, and they provide a wealth of tips and tricks for novice investors as well as for more sophisticated investors. So there's all kinds of things. That's Tom O'Hara, longtime chairman of Better Investing for over 50 years. And you might have heard of the Beardstown Ladies up in the upper kind of left center right there. The Beardstown Ladies were a phenomena in the 90s. A group of women out of the Heart of Illinois chapter down in Beardstown, Illinois, a group of ladies that got together and ended up beating the market and beating it quite soundly. They got a little bit of bad press from somebody that liked to knock down investors that were normal, rational, real people, but the numbers don't lie. These ladies put together a phenomenal portfolio, and this particular club still exists today.
Yeah, in fact, I'm hoping to become an honorary member someday, as soon as I can get them to break down that gender bias that they have. All right, let's keep rolling, Ken. We're going on here a little bit. All right, well, last night we talked about in the second session finding those up, straight, and parallel companies. That is the definition of quality. You see a visual analysis of a company on the left, where the sales represented by the top graph in green is a straight line and up and to the right. The earnings per share graphed over time is the blue line at the bottom. When we are chanting up, straight, and parallel, we're talking about those lines. And then from a numerical standpoint, and perhaps a defining standpoint, we do believe that those four characteristics in the image on the right do represent a pretty good look at the quality of a company. The financial strength, one of the things we do like to point out that in that NAIC Investors Manual, one of the first topics treated was the balance sheet and how to look at the financial strength of a company. So it's obviously important. We do like to see straight lines, earnings stability, and then we do like to compare the growth rate and the expected profitability of a company to its peers and competitors, and then build a quality rating or ranking out of that exercise. Anything you'd
And
like
it's
to add
key
there,
for
Ken?
us. Yeah, it's key for us to understand that when we're talking about quality and relative growth, we're speaking about sales growth. Remember, everything comes from sales. Everything begins with sales. And we're looking for companies that compare favorably to their peer group. And by favorably, I mean, and these are in the words of George Nicholson, we'd like to pick the one or two best companies in an industry, not go with somebody that's average or below average as far as relative sales growth is concerned.
Absolutely. All right, we mentioned Walter last night. I thought I would just bring it up one more time as kind of our summary of what we want to do here tonight. And this just makes the point of anything that you can do to gain an advantage, whether it's in cost savings or finding something that works. We believe that investing regularly can add a percent or two to your investing experience. We also believe that quality matters huge. And two other things that we do, we actually believe build an incremental potential advantage. If you can go up that ladder even a couple steps, those numbers become quite staggering over a long period of time. And there's obviously a lot of clubs out there that and individuals that are at the top end of that ladder, and it's just a wonderful thing. So we just wanted to reinforce that. The rest of the night is going to basically be focused in two areas. First of all, purpose-driven prospecting. We're looking for up, straight, and parallel. Quality companies with good return forecasts or great return forecasts. And then we also are going to look over the shoulders of people who have demonstrated an ability and demonstrated success. So let's take it further.
It's important to internalize some numbers. That 10% is boxed in right there because remind yourselves, in the last couple of sessions, we've been talking about 10% being the average return of a stock in the stock market over long periods of time. So that's the average return. We told you that we do a roundtable portfolio that presently is, what is it, about 15 or 16%, Mark?
16.
16%. Look at the difference between a long-term 16% compounding and a long-term 10% compounding. If you can even do 12 rather than 10, you can practically double what you're doing in your nest egg. So beating the market is something that Nicholson stressed. He set as a goal for his clubs to beat the market by 5 points if they could. He didn't expect them to do it on a regular basis, but he said aim high. And that's what we're asking you to do as well. Aim high. It's better than average. Average is good, but better than average is obviously better.
All right, and one last reinforcement. Walter was a friend of Warren Buffett. That's putting it mildly. He worked right next to him for years. And again, he invests just like you and me. And that's an important aspect of this. So first homework for the night, at Manifest Investing, you can search on Walter Slosh and find a bunch of different articles. We've written a number of times and collected up some real nuggets of wisdom from Walter. Or you can just simply Google and you will find plenty of interesting reading that is really grounded in the foundations of the type of investing that we are talking about tonight. All right, is this where I get to do my Motown review tonight, Ken?
You can talk about your musical comedy creds tonight, Mark, okay?
Well, I seem to have this fixation on Julie Andrews and Mary Poppins, and Ken embarrassed me in front of the New Orleans audience by pointing out that I was mixing up my movies. But anyhow, what we're going to spend a little bit of time with here for a few minutes is one of my favorite screens. Uh, the screening tool is from Manifest Investing, and I just wanted to give you a smorgasbord of the type of things that we can go searching for. Now, in last night's session and with the beginning remarks that we made a point that you want to focus in on the quality of a company. You can see that you can search on quality here. You can also search on the projected annual return. of a collection of stock selection guides based on analyst consensus estimates. So you can see that there's a number of things put together there. The manifest rank on the lower left, now this is a little bit heavy, but I think you can handle it. It's simply recognizing the two most important characteristics are quality and the return forecast. We combine them into one thing, kind of an index if you want to think of it that way, so that you can actually use that to search. And down the middle, you can search for companies with a sufficient growth rate, or you can search for companies that are trading close to a 52-week low. Now, these are all topics we could spend an hour talking about. And as you continue your trek and your progress as a beginning investor, you're going to find pretty cool applications for that. Anything you want to add here, Ken, before we dive in?
Let's dive in. We plan to go maybe 70, 75 minutes this evening, and we plan to get real near the end of this session and go to the actual screeners and do some real-time screening. So we're going to show you how it works first, and then we're going to actually work it right in front of you. So let's look at this first one here. Off to the right, you can see the criteria that are being used. We're using triple play criteria. We're using the sweet spot. We're asking for par that would be in the sweet spot. And we're asking for growth above 12%. If I were in a classroom, I'd be asking people to tell me what kind of companies are we really looking for? And I'll answer my own question since I can't see your hands. We're looking for faster growing companies. In most cases, these faster growing companies that are growing better than 12%, are companies that are smaller in nature. It's not always true, but in most cases that's true. And we look over to the left now, and here's a truncated list of some of the better high quality growth companies that exist. We're not going to take time right now to explain what triple play is, but it gives us high quality companies. We're
Okay.
not going to take the time to explain sweet spot, except to say that it's beating the market by 5 to 10 points. I defined it, and you can see that up in the upper corner up there, we have MyPar. That's the manifest investing potential annualized return. The average stock is expected to return about 12.5%. At the end of 2023, that number was down around 10.5. So the last 3 days of trading have raised the average potential by about 2 points, a little bit less than 2 points, and that raises the sweet spot. The sweet spot is nothing more than 5 to 10 points above the average. Mark, what are you going to add?
Just that it's an interesting list of companies, and Globus Medical was featured at a recent roundtable. You can go to the roundtable on YouTube, and you can actually search and see Ken's presentation. I believe it was from last month, not the most recent month, but November
I
2023.
know I know we have folks in the room from BI Baker Model Investment Club, and they just purchased Mark EXLS, Excel Service Holdings,
Mhm.
after a fairly intensive industry study. They thought it was one of the best companies in the information technology sector.
Okay, so this was just an example of going hunting for, basically the purpose driven or the results that you want to get from investing, and pretty cool stuff. Now, here's one of my favorites. Again, we've been talking a lot about this. The quality and the return forecast, known as the projected annual return, are the two columns on the far right. And we're basically just asking the question using that manifest rank index. And I actually entered 99.44. Some of you will remember that from the Ivory soap commercials from years ago. So we're actually looking at the top 0.5% of the companies in the database. There's now about 2,800 companies. And just saying, show me the companies that are very high quality, excellent companies that are potentially attractive from a return forecast or slash price standpoint. And pretty decent list of companies. Going to be some repeats, obviously, but here we're allowing some of the bigger companies in here also.
I will answer one question that we have from the back room, although we're going to try to save questions that aren't directly involved with the screens we're looking at till later. But the yellow background on a par value just means it's above the sweet spot. And when it gets too far above the sweet spot, remember that top of the sweet spot would be 10 above average. When it gets too far above that sweet spot, it might be too good to believe. All of these yellow backgrounds and these 6 yellow ones on this screen, however, are very close to that 22.4, which is the top of the spot. And so I probably have some faith in almost all of these. I will tell you that this list is a beginning list. Mark has said it once tonight already, and I'll say it again. This is where you start your study, not where you buy from. This is where you begin to do studies. I would also tell you that if you're doing a real careful job, you probably would only choose 5 or 6 from this list to continue studying. They're not all as interesting as each other. Some of them are extremely interesting, and some of them you might discard for one reason or another as you begin to learn our methods.
Great point, Ken. And I want to another disclaimer. This slide is actually a little bit dated. We don't do that very often here at Manifest, but this one is from a few weeks ago. But I would direct, especially the beginners, attention to Planet Fitness down at the bottom. Scroll over to the right and read the financial strength at 11%. So you're basically talking about a company that has a comparable financial strength to value line at a C plus rating. To a beginner, I would say be very careful. Anytime that number is below 50, you want to treat that company with extra caution. And when it gets down to 11, be extremely careful. You're in an area where the company could, frankly, be damaged goods. And I'm not saying Planet Fitness is damaged goods. I'm saying it could be.
I will direct you to another stock on this list, and it's about 2/3 of the way down. The name is XPEL. The ticker is XPEL as well. It's an auto parts company. Actually, it's a paint kind of company providing different finishes for paint. And if you're looking for significant negative press about a company, you can read all kinds of significant negative press about XPEL, and that's what's driven the price down so much. It's important for a beginner to understand that as price is driven down for a stock, the potential for the stock begins to move up, or at least it does initially. So I'm looking eventually, if the press is correct about XPEL, I'm looking for the par value to start to slide down as the analysts debate whether all of the negative press is true or not true. But it's a company to actually put a really big star by and say to yourself, I want to make sure I read an awful lot before I put my money down on this one.
Okay, let's go ahead and roll to the next screen. This is one that, again, this is a little bit more advanced, but we wanted to include it because this is the explanation that we would give when you see somebody on CNBC, whether it's a guest money manager or one of the panelists or analysts that are on CNBC. They talk about stocks being way oversold or way overbought. And the brief explanation is the relative strength index, which is abbreviated RSI here, is anytime it's below 30, there's a chance that that stock has been really beaten down in price, maybe overdoing it. So it could be an opportunity. At the opposite end of the spectrum, if the relative strength index is above 70 or 80, that suggests that the stock could be getting overheated. It could actually present with an opportunity to do a sell analysis on the company. In this case, what we are looking for is companies on this particular day, and again, this is a dated slide, but probably not from too long ago, of companies that are basically oversold. And in this case, the top company is one of those companies in Israel that's involved in that crisis over there. And even though they don't have any actual business there, their office is in Tel Aviv. So they had been beaten down, and this type of a screening result is literally just a field of potential studies. Sometimes it's a minefield, so you got to be careful.
We are getting a lot of questions about unrelated topics, but I am going to address one, Mark. We had a couple people ask about what yield means. And yield is the dividend yield. You'll find as a novice that many of the up straight and parallel companies that you're going to be studying, especially the faster growing up straight and parallel companies, you'll find that they don't very often offer a substantial dividend. Now, what is a substantial dividend in today's market? Probably somewhere at 3% or above would be considered substantial. Probably the average dividend being presented by stocks today is less than 2%. And finding zeros in high growth companies is not at all unusual.
No, not at all. Okay, so this is just literally a hunt for potential opportunity. Here's that definition just to give you a picture. This is from stockcharts.com. That's a free website where you can search on this topic in their chart school, what they call their chart school, and you'll get the narrative behind all this. But this is just illustrating how the relative strength index moves with the stock price, and what again, the people who do this type of analysis, and there's a whole lot of people on Wall Street that do. Basically, you see the overbought and oversold situations down at the bottom of the page. Okay, so I use this one. Go ahead, Ken.
No, go on. I think maybe you're going to say what I'm going to say. Go on. You are. Go on.
I use this one. It's not my predominant style of investing, but I do like to often start with, what might be getting really beat up by the analysts and the institutional investors, because if there's one thing that's reliable on this planet, it's that they go way too pessimistic, way too optimistic from time to time, and it gives us opportunities. This particular slide here is from a particular day. It was right back in the middle of the pandemic with COVID. And it was early on, and things were ugly out there. And one of the reasons we included this here tonight is to make to take that message to beginners. When you turn on the TV or you look at your newspaper and everybody is moaning and groaning and screaming about how nasty the stock market is, that's when your ears should go up and you start looking for opportunities. So this particular morning, maybe Kramer was on that morning saying, run for the hills. I don't know. I hate to pick on Jim, but there you go. So I sat down that morning and did this screen and found a whole bunch of companies, many of which are the type of company that I'd be attracted to if they ever went on sale. So you can see there are a whole bunch of low relative strengths on here, and did take advantage of some of those. You can see how dastardly that drop was for Chef's Warehouse on the right side of the screen. Ken, what were you going to say about this moment in time?
I was going to say that a lot of times we should heed the words of Warren Buffett, and he suggests that the best time to invest is when there's, and I'm paraphrasing, but he says when there's blood in the streets. That's one of the best times to be an investor. He has been publicly wishing for times like happened at the time Mark is explaining right here. And when you look back on these times, you look back very fondly because you've been able to pick up some stocks at terribly, terribly attractive prices. I still have some of my best home runs that I bought during the financial crisis back in 2008 and 9.
Yeah, in fact, Warren Buffett back in that time frame actually said, "I hope I live long enough to see another one of these." I mean, wow. So there you have it. So anyhow, I did actually take a position in a few of these companies. I actually missed Chef's Warehouse because I went upstairs to make myself a hot dog, and came back down, and it actually had gone up like 50% in one morning or something. All right, here I just wanted to show that a year and a half later, after that date in March 2020, how well some of these beaten down stocks actually performed. And you can see there's some pretty spectacular returns on that slide. So again, it's an area of opportunity. Again, the message for somebody who's relatively new to this is when things are really ugly on the tube, um, that's when you probably want to turn the TV off and go shopping for a better company at a better price. Okay, anything you'd like to add to this one, Ken? I think we
No,
got a
I
couple more.
like it. Oh, there's your picture again, Mark. Okay.
Yeah, I'm going to wrap up my stock screening slides by Ken actually captured that picture without my permission as I came off the tennis court up at Burr Lake in Michigan one day. Now I have kind of let myself go a little bit since that day, but no, this is the importance of core, taking care of your core. And Ken and I talked about whether or not we could put this in here, and then we kind of came to the conclusion of all the stuff we've been talking about here for the last 2 days really does reside or revolve around these companies that have excellent financial strength, and they have up straight and parallel lines, so their earnings per share stability is high. And we want companies in the upper 10 or 20% of all companies. Those are the three elements that go into our core rating. You can search for the highest core companies at Manifest, and you can see that there are some really cool companies on this list. And I would say for a person relatively new to this is a relatively safe area to go shopping. What are your thoughts, Ken, other than admiring my physique?
I I do think that just like any other screening list, you have to be careful. There might be a couple of ringers on the list. There might be a couple of companies that have their own unique problems, but as a group, I think that you're absolutely correct. We're looking at some fairly safe companies, and we're looking for some very decent companies that you might want to study. I think Mark has put arrows at three companies in particular that we think are pretty decent to include in portfolios. I would put an arrow next to Tractor Supply up there as well. And I would put an arrow next to Gentex up near the top of the list. There's a lot of really great studies on this list. And this might be the kind of list that you share with an experienced investor that you know, and you might say to them, how many of these companies do you own? And if they can't tell you that they own 4 or 5 from this list, then they are probably not investing the same way that we are. If you're going to be a better investor, then you own, 4, 5, 6 or more stocks that are right on this list.
Okay.
Mark, I'm glad we addressed on this slide. We did have a question what the core score was, and you mentioned the 3 columns. Can you talk briefly just how the core score is calculated from them?
Yeah, we simply add up those 3 columns. So for the top one, Taiwan Semi, it's 98 plus 98 plus 100. A perfect score would be 300, just like bowling. So that one is actually up at 296. That's the top one. So we add the 3 together, and again, it's squishy. Anytime we think that anytime a company is above 225, 230 or so, it's generally going to be regarded by experienced investors as probably core. So that's the way we basically look at it. And again, it's rough, it's squishy, but we're pretty impressed with the type of companies that it will generate in an effort like this. Thanks, Matt.
We are getting our audience, which is always participating when they have a chance to, and I'm hearing from a number of people in the audience that they own. We have one of our friends from southeastern Michigan owns 7 stocks on the list. We have another person that owns 8, and we have one person that owns 11 from the list. So I think what we're saying about this list being a list of some of the very best kinds of up, straight, and parallel companies, I think it's true.
Okay, pressing on, Ken would like to share a little bit about the resources available to do some of this type of discovery at Better Investing.
This is from the SSG Plus, and I know that if you're a Better Investing member, many of you have access to the SSG Plus. Unfortunately, I know that a lot of novice investors have opted for either a club membership or a membership that only goes to basic right now. I'm going to be doing some screening with the Plus, and everything that I show you is not necessarily available if you're just a basic member, but let me show you some of the things SSG Plus. You get to the SSG Plus once you get to the tools by pressing that spyglass over there. Give me a click mark if you would. By pressing that spyglass over there on the left-hand side, that will take you to the screener. Another click mark. And the screener is basically developed or divided into 3 different sections, and I've numbered them 1, 2, 3 right there. The number 1 is when you want to set a lot of criteria yourself. Number 2 is when you want to look at predefined screens where somebody else has set the criteria. And number 3, if you're a real visual person, we'll talk about number 3 in future classes. We're not going to develop that tonight, but let's take a look at the first 2 kinds of screeners and how we can use them. I'm going to start with my favorite predefined screens, and if you give a click mark, my 2 favorites right now are the small company predefined screen and the A-list stocks predefined screen. And another click mark. You can find what the screeners are actually screening for if you press the question mark right next to the A-list stocks or the small company stocks. And Mark, if you click again, here's what the A-list stocks, the criteria that have been set. Read this at a later time, but the criteria are very clearly spelled out for you. Next slide, Mark. When you actually press the single button, A-list stocks, you get a list of 34. I know it's 34. Do a click for me, Mark, because down in the bottom corner right there, it says that I'm looking at 1 to 34 of 34 entries. So out of about 7,000 stocks plus in the database, 34 of them have met the criteria for A-list stocks. And I think if you go through these stocks, you're going to find that many of them are the up, straight, and parallel model that we're actually looking for. Some of you might recognize some of the names at the top of the list right now. I see Costco, I see Adobe. You might recognize them, and others might be completely foreign to you. Addis Home Care or Brown & Brown might be companies that are not familiar to you. Do another click for me, Mark. You can take and filter this list or sort this list, either one by industry. There's a little box down here, and if you start to type in particular industry or a particular sector, you can sort the list. Do a next slide for me, Mark. And here I've typed CONS, and the list has now resorted itself to any sector that starts with the letters CONS. There are 2 sectors that start that way: consumer cyclical and consumer defensive. These are the Morningstar sectors that we're using to divide all the stocks into different groups. Do a click if you would, Mark. There's that filter again that I spoke of, and another click, please. And another click. There we go. If the list were any longer, I might filter by the industry column as well as the sector column. Here I've finished typing the word consumer and started the word cyclical to bring up the consumer cyclical companies. I happen to own O'Reilly Automotive, and in one of my IRAs, I happen to own Tractor Supply, two very, very up, straight, and parallel kinds of companies that would be high interest stocks for a novice investor. Click again, please. And another click. To reduce to a list to a manageable supplies, I can preview the data. I'm back to that list of 34 again, and this time I'm going to go to the little button. There's two actions I can take, and I'm going to choose the action button that's to the right in the actions column. And if I press that button, I get this thumbnail, and all it shows me is the sales, that's the green line, and the earnings, that's the blue line. And it shows me those dots for 10 years. The little dots kind of hanging off the end on the right are the two most recent quarters that exist. And all I'm looking for when I look at this thumbnail is up, straight, and parallel or not. I would say yes. This one is, and on my short list, I would put, out of the 34, I would put Addis Home Care on my short list. And then another click mark, I would look at these buttons at the top of the thumbnail and one more click, and I'd press that button that I circled, which is the universal button for next one. So I'm going to press that next one button. I have to remember that everything I'm looking at is the beginning of a study. I'm using the thumbnails for guidance. You can imagine that if I were to go through the entire list the way I went through Addis Healthcare, just asking myself the one question, up, straight, and parallel or not, I could take and reduce that list from 34 down to perhaps half or fewer on the list. Once I have my list of up, straight, and parallel, and I've gotten there by using the thumbnails for guidance, then I would begin to submit each of those stocks to an analysis. This process works. It might take me 2 months to go through 6 or 7 stocks as a novice. Be patient, be diligent, start the process and spend maybe a half an hour every 3 or 4 days dealing with the concepts. The more you do, the better you'll get. Find friends, maybe join a club even, and find people that have an interest in investing with you. If you can't find somebody from outside, convince your spouse or your son or your daughter or your next door neighbor that they should become involved in investing, and then start to pass ideas back and forth. I hope never again to hear the lament, I can't find any new ideas from anybody in the better investing community. One more click mark. Take control of what's going on. When you find stocks, if you have some cash and it's a buy, then take the plunge. Open a brokerage account and begin to put a portfolio together and keep learning. There are free webinars every day. Every week of the year offered by Better Investing. And there's a learning center with more material on the learning center in Better Investing than you can get through in a year. There's also a complete learning center on manifest investing, as well as a very active stock forum where you can ask questions. Here we are on the other part of the screener where you can set criteria for what you're going to do. Notice that basically it's pretty simple. Do a click for me, Mark. There's a pull down list next to most of these things. Click. And when you pull the list down, you can set different percentages. Here I'm asking for 8% or better growth in sales and in earnings. And I've left R squared at 0.7. You could leave it at anything greater than 0, since we haven't even discussed what R squared is. I've said, I don't care if it's a small, medium, or large company, I'll take any of those. So I turned them green. Any sector, any dividend yield. I said, let's have the pre-tax profit. We talked about that yesterday. Let's have it even for the 5 or 10 year period or up. And let's have something that we don't know about yet, return on equity. Let's just make it even or up. If you want to make it even up or down because you don't know about it, that's fine. I set Morningstar grades of B, but you don't have to set any grades there at all. And then you hit the search button. And you get, in this case, I found 47 different companies. Notice that there's a slider bar. I'm pointing to that gray bar at the bottom of the list under CDW Core. That slider bar means there's lots of data off to the right that's hidden. Notice also another click mark. Notice also that there's a slider bar up or down because there are 47 entries on this list, and I can slide and take a look at any of them. I have filters along the bottom. I can filter it by sector or by industry or by size of company or by lots and lots of other possibilities. This cannot be broken. And it's extremely intuitive. Click if you would, Mark. I call it Better Investing's Adult Sandbox. Play. Go in there and play for 10 minutes or 15 minutes. Come up with some lists and then copy 3 or 4 ideas from the list to put on your further study list. It's always wise to have a further study list. I even watch television with a pad, and I jot down when I'm watching business television any company that they're talking about that seems interesting. Frankly, I don't get a lot of great ideas from television, but it's something to do and it keeps me busy, okay? Play with these tools, whether they're manifest investing tools or better investing tools, or whether you're screening using Morningstar or Value Line or any of the other screeners that are available out there on the web. Just make sure that you understand that screening is step 1 in the process. It's not the step before you buy, sell, or hold any particular stock. Next slide, Mark. There's what we're looking for, folks. Up, straight, and parallel. Take over, Mark.
Again, just reinforcing what we talked about a little bit last night. It is possible to invest a set amount a month for a number of years and generate a really nice nest egg. One reinforcement that I would make, just to put it in present day context, think about how much money $20 was in a month back in 1948. Let that sink in for just a minute. That would have been equivalent to a car payment today. So again, if you're going to do the Tom O'Hara thing today and you're relatively new to this, you want to be thinking more along the lines of trying to generate enough breathing room to be putting aside something on the order of a car payment to get to where you want to end up. All right.
And Mark, I think we'd also be remiss not to tell people to leave money on the table. Make sure, folks, that if your job is matching funds when you might put it into a 401k or a 403b, or when you might even put it into a Roth IRA or an IRA, if they're giving you money to do that, I would suggest that that's the investment that has the highest return before you start buying stocks in a personal portfolio. Personal investing, I think, should come after you've made sure to snap up all the free money that might be available through your employer.
Absolutely. I'll second that. All right. One of the other topics we wanted to touch on briefly, and we actually do a lot of this at Manifest Investing and in the programs that Ken and I run with bull sessions and occasionally even at the round table, we like to look over the shoulders of people who seem to know what they're doing. It's kind of like knowing who the best students are in the class and cheating off their, no, I wouldn't say, Ken, I didn't admit that. Find the best students and figure out what works. What are they doing that works? What you're looking at here is a list of the top 20 companies by their market outperformance. That's relative return, that right-hand column. But you can see this is basically for most of these a 10-year picture, and you can see which funds or exchange-traded funds. Again, as a person fairly new to this, you can buy either a traditional mutual fund. Those are the ones with 5 letters in the ticker, or you can buy what's known as an exchange-traded fund. Look up those terms and develop your own understanding of what the two differences are. You probably saw commercials during last week's college football games for QQQ, Invesco QQQ. That's an exchange-traded fund that invests in the 100 top companies in the NASDAQ index. So these are companies, these are funds that have beaten the market. So we make the assumption perhaps they know what they're doing. We will use many of these as sources of ideas for great small companies to study, and that's what I wanted to show you here tonight. One of the newest additions to the list is a fund by Jeremy Grantham's firm, GMO. It's called Small Cap. So again, it's talking about smaller companies, faster growing companies for the most part, that also have quality characteristics. I don't know about you, Ken, but my enthusiasm just went up at least one notch with just those two characteristics. Fairly new funds, a little over a year in operations, so any of the holdings in the fund are going to be relatively recent selections. So we watch these funds, we actually pull up their holdings, the list of holdings at Morningstar or any place where you can get the list. And for GMO small cap quality, here's what it looks like. And Ken, I'll let your mouth water.
There's that one that's done the best for us in the past year on the roundtable. There's that Fabrinet, Mark.
Yeah, and there's a bunch of companies. Trex, Ollie's has been a part of our activities. Fox Factory, Balchem has made a lot of people in the better investing community quite happy. How about that one at the bottom, Globus?
Awfully happy to see Gentex and awfully happy to see MedPace on there too.
So the point to be made here, again, these guys apparently eat breakfast just like we do. They appear to be interested in the type of companies that we are interested in, so they can be a source of ideas. What we will very often do is just pull up the most recent list of holdings and see what's new, what's been added to or accumulated recently, and then go check it out just in case it might trigger further interest. And from top to bottom, that is a list of relatively obscure, in some cases, community favorites. That's fun. All right. Here again is that reminder. And this goes back to what happened during the pandemic with COVID And I just love the quote from Michael Batnick, because this has come true for many of us, either in 2008 or in 2020, when the stock market fell apart like that. You really do want to shut the tube off, throw away that newspaper, and go shopping. And it's never easy. I mean, you literally have to grit your teeth to do this sometimes, but when things are really bleak, um, it's generally a potential to be really rewarding. Hard to remember, and it takes a lot of discipline for this one. Anything else, Ken?
Nope.
All right, and there's a look at McDonald's and the relative strength index, just reinforcing where you might find some of those opportunities. Again, going back to that slide that was
Mark,
there.
I do think if you back up 2 slides, that what you said down there at the bottom was really important.
Okay.
Next slide. That one right there, that while the market looks at 70 and 30 as the 2 dividing points, we tend to be a little bit more strict, and we tend to say, let's let it go above 80 before we think it's oversold, and let's let it go below 20 before we think, and I got those reversed, don't I?
Mm-hmm.
Let's go above 80 for overbought and below 30 for oversold. Oh boy, I messed it up. Go ahead, Mark. Explain what I'm trying to say. Okay.
Again, a stock can really get overheated, and in other words, the stock price just shot up high, and maybe overshot its mark a little bit when it gets above a relative strength index of 80, and that's when the hairs on the back of our neck go up, and we'll actually look at it. Might it be a situation to sell? That's obviously a subject for another day. On the other end of the spectrum, again, below 20, going back to this example, that morning there was a whole lot of stuff that could be done. There's my hot dog. And again, looking at that same situation 3 years later now, wow, some of those companies on that particular morning, when everybody was moaning about the stock market and talking about selling all their stocks, these were the opportunities that presented themselves. All right, Ken, do we have time to go through Tina?
Real quickly, Mark. Yeah.
Okay, I know we're at an hour. Ken got us started on the Motown thing, so I want to talk about simply the best in this one particular screen known as the triple play. It is absolutely a community favorite. What it has to do with it, again, we offer it at Manifest as something you can search on. What you're basically looking for is a company that does have one of those depressed stock prices or elevated return forecasts. And then we're also looking for a company that has the potential for an increase in that PE ratio that Ken talked about last night. And then the third criteria is an opportunity for margin or profitability enhancement. So you basically go looking for those 3 conditions in the Manifest screener. And I'm just ripping through this just basically to show you that it is a really time-honored proving ground for finding companies that can help you, especially during bear markets and corrections, perhaps even recessions. So look up the triple play. There's a number of articles on it at Manifest, and it's covered fairly extensively in the better investing literature.
What I'd like to do, Mark, is go to some of the screeners now and do a little bit of live screening right in real time, right in front of our audience, if we could.
Okay, let me see if I can take control from here. Do I get to go to my favorite screener?
You can start with your favorite screener, Mark.
Actually, it might be safer if you do this, Ken, based on with our current situation.
Okay, let me do that then. Okay.
Okay.
I'm going to take the presenter. Okay, and I'm going to get off of that, and let's go real quickly to Manifest Investing, and I'm going to do stock screening and do a new stock screen. And one of my favorite screens, Mark, is the Ivory Soap screen. I really like that one. And the screener is really very intuitive, and you can't break it. We're in real time now. I'm not going to talk about sweet spot. I'm going to keep the no. I'm not going to talk about triple play. I'm going to keep the no. But I'm just going to go down to manifest rank. Did I pass it?
You scrolled by it,
Yes,
yeah.
I did. Right is right there. And I'm going to use, and we call it ivory soap. Those of you that are as old as I am can remember the commercials that said that ivory soap was 99 and 44 100% pure. And that's why it floated. That had nothing to do with why it floats, but we'll let that be for another day. And now I'm going to go down and hit search. And I've come up now with a group of not very many stocks. If you look, there's probably at the most there's 15 there. But I'll tell you that this is a group that probably you can legitimately study 6 or 8 of these without really being too worried. Remember that this yellow background means that it's just off the top of the sweet spot. If it's just off, like all 6 of these yellows are, 7, 8 yellows, then it's not worrisome. If these numbers were 30 or 40, then we're looking at the situation where it's probably too good to be true. We've studied Globus Medical at the roundtable a number of different times. We've studied Green Brick Partners at the roundtable. Matt Spielman did a wonderful presentation on Green Brick just last Tuesday, just 2 days ago, day before yesterday. You might want to go to YouTube and check that presentation out. This is quite a stock, folks, quite a stock. We're looking at NVIDIA, which everybody is telling us is either the next best stock in the possible universe to own or the worst stock in the universe to own, depending on who you're listening to. We're looking at a great Michigan stock, and those of us that live in Michigan always love when you buy Michigan companies. So we won't ask you to buy Ford, GM, or Stellantis, but here's Gentex, a great auto parts manufacturer that you might want to study. It makes for a wonderful study. Also, Montclair, a very small company serving very high-end luxury goods to the general public, and most of it being sold outside of the USA. There's just so many other companies, but there's a few duds on here. Tencent. I would be very cautious when you're studying Chinese stocks, and this is a Chinese stock. Grupo Aeroport Pacifico. I would be very cautious when you're studying certain South American stocks, and this is a certain South American stock. I would be very cautious when you're looking at a REIT, because a REIT has all kinds of extra things that you have to kind of worry about. REIT stands for Real Estate Investment Trust, and it's a little bit much, it's not a little bit, it's quite a bit more difficult to understand the vocabulary that goes into REITs. I've told you about the bad press that's associated with Expel, but here's Pfizer, a really highly well-known stock that makes for an unbelievably decent study, especially if you pull in 3 or 4 of the other drug companies and study them in a group. So you can get wonderful lists just by taking the time to do the manifest thing. Mark, what's your favorite screen in manifest?
Well, that is my favorite screen, and I would just point out Pfizer is really in the dumps lately with their stock price. So it could be an interesting thing to look at. One of the other things I did want to mention while Ken is tooling around here is um, I took a position in Novo Nordisk, the company that's all over the press for the obesity pills a few years ago. But what I wanted to point out to relative newcomers, that company was in my basically pounce pile or watch list for 8 years. I waited 8 years for it to reach the point of being attractive enough to buy. And has it ever been rewarding ever since that news came out? All right, so Ken is looking at the relative strength index.
Mark, can you tell me why we're getting all these zeros on RSIs right now?
No. I can't imagine unless just hit some glitches
Okay,
or something.
so we're going to stay away from that one for the moment. There's a glitch in the database. I'm going to take a real quick look at the Better Investing Screener, because one of the habits that I've gotten into is to look at the small screen. And I told you you get to the screener by pressing the spyglass, and there it is, the spyglass over there. There's the screener. I've got in the habit of running this small company list, and I just ran the list. I pressed a single button, and here's the list. Tonight, it happens to have 10 entries. And I've been running this list for now the last 8 or 9 years, and I run it maybe once every 2 or 3 weeks. And all I'm looking for are companies that are new to the list. I see SPS Commerce Incorporated, and that's kind of new to the list. So what I do is I press the thumbnail. And you know, I kind of like that graph because I have the last 5 years of the company, and I'll count them out for you. 1, 2, 3, 4, 5, and I'm seeing up, straight, and parallel. If I disregard 17, and I have a hunch what happened in 17, I can't do it on this thumbnail, but if I disregard 17, then I have a really nice growth company for 10 years right there. What I might do for this company is I might click it and actually look at the entire graph. And now I'll take that 17 out of there. It smooths it down. I'll take some of the slower growing stuff out of the data just to get my trend lines closer to the data that's there. I'm looking at a company that grows at 15% sales, and for the last 8 years has been growing at 45% in earnings. Let's see what happened after that dip year. Here's the 5 years, 1, 2, 3, 4, 5, and actually sales went up and earnings are more closely aligned to sales now at 20%. I can even see what the company does. A provider of cloud-based supply chain management. It's a small company. You know, this one might be one that I would put on my list to study further. I really like the fact that the management trends are all green. I'm looking for debt to capital that's practically nothing. I'm talking about things that I can do to read an SSG, and that's the class that I'm going to be discussing on the 11th during a Better Investing Stock Up. We're going to be doing Is It Reasonable? And we're going to be talking about how to read an SSG. What do some of the things mean, and are they good or bad? Not how to prepare, but how to read the SSG. It'll be a stock up starting at, I think, 8:30 that evening. And you can register for it on the Better Investing website. Mark, let's go back to your screener. And do you have another screen we might want to take a look at?
Okay, well, probably my favorite, besides all the other stuff, would be just simply, why don't you give me a quality rating greater than 90? You want to return too? Okay, well, quality greater than
No,
90.
I'll just do quality greater than 90, yeah.
I want really strong balance sheet right now, so give me a 90 on financial strength. So that's like an A+ rating for financial strength. And I'm really interested in faster growing companies right now, 12% there for the growth forecast. See what you end up with.
Okay.
So a strong balance sheet, exceptionally high quality, and relatively.
Okay, not a huge list, maybe 15 or 16 companies.
I do like
Okay.
Houlihan on there. That's an Ann Manning selection for the round table about a year ago. Viva Systems is in many portfolios.
I think that folks would be very happy if they were to do a Google study right now too. It's one of the Magnificent Seven that actually has a fairly decent PE value attached to it.
There's my Novo on there. again, Novo, if you're not familiar with it, is a company out of Denmark that provides insulin and care for diabetic patients. And they are one of the two major players in the obesity stuff that's going on right now, alongside of Eli Lilly. So that they've had quite a run. So you want to be aware of that. Yeah, there's
I love
a
to
number
find
of companies.
companies, Mark, where they provide everything in the way of backroom support to a major industry. ASML does lithography for computer chips, and they have customers that are every single other computer chip maker in the world uses ASML technology or actually uses ASML to do the lithography. This is a foreign company. It's a Dutch company, but it's extremely interesting study to take a look at.
There's another one on here that's a personal favorite of Ken's, MP Materials. The ticker symbol is MP. They handle all of the, or a great many of the rare earth metals that go into electric vehicle batteries. And it's a really interesting study. And you want to talk about a company that's really getting beaten up by adverse general media press right now. The EV industry is really in kind of a state of turmoil, and I suspect that is probably weighing heavy on this company. So again, as you study it, you want to be aware of the environment, all that bad news out there. We're sitting here riding in a hybrid vehicle right now that has a battery in it, so I think they're here to stay. Just a matter of how quickly they get adapted.
Mark, did you mention Ensign Group on this list? Didn't Ann Manning do a study for the roundtable on Ensign Group?
She may have, and it could have also been. Trying to remember. I don't remember off the top of my head.
Oh no, it wasn't Ann. Ann, I apologize. It was our friend from Traverse City.
I could have named her if you hadn't mentioned it.
Yeah, well, it's not going to come to me, but it was in Roundtable 2 times ago. It's a really nice study as well.
Mm-hmm.
Let's do one more real time stock screen, and then we have to call it a night. Okay? How about if we do a stock screen and just look for sweet spot and just look for quality in the sweet spot at 85 or above.
Tell you what, why don't you go down and hit the 52-week. Okay, a small company, but down percent from 52-week low. And this is a stay within 20% of a 52-week low, so under 20.
Okay, we might end up with a null screen. Let's see. No,
we got it.
We actually have 4 screens, and I will tell you personally, we just finished a study on Excel Service Holdings, and that's an excellent study to take a look at. And it appears to be quite undervalued right now.
Yeah, and the reason I bring it up is this is a Hugh McManus. He's one of our roundtable nights. He's the pharmaceutical scientist that we talk about quite a bit. One of his favorite things is to go searching for stocks that he has vetted for high quality and good characteristics that are trading close to their 52-week low. Ken Janke from the NEIC used to do the same thing. And I'll give a second homework assignment for tonight. Go back and look at the high and low prices of a number of companies. And what we want you to notice is the difference in any one calendar year between the high price and the low price. And what you will find is that the low price is often 50% or even less of the high price for the year. So Ken and Hugh are basically just suggesting why wouldn't you want to be more attracted to the companies that are down at that end of the 52-week price range. It seems like a little bit of insurance. And again, just an interesting way to take some of the, it's a good approach to hunting down some good opportunities.
And I will tell you that if you're interested in a bank, Farmers and Merchants is on my short list of banks that I'm extremely interested in right now. Farmers and Merchants, along with One OK or One Oak, both of them. I'm sorry, Bank of the Ozarks, it's called now.
Mm-hmm.
Bank of the Ozarks is another one that is on my very short list. This is a great screen. There's at least two good ideas. I'm not familiar with Vicor, and again, I'm very leery of Chinese companies. So. Mark, we're going to have to call it a night. You might be getting the idea, folks, that Mark and I can do this for the next 2 hours because it's our passion. But we're going to have to call it an evening. We will try to stay after we close the broadcast down to answer some of the questions that we didn't feel were directly related to the topic, but we can try to answer before we leave. So I want to thank you all for coming. It's been a really interesting, wonderful time for Mark and I. And I will tell you that Mark did everything that we heard tonight coming from a moving car on his way from Florida back to Michigan. So Mark, a round of applause for the fact that it worked. Okay.
Hey, technology.
You got it. Okay.
And my wonderful, significant other half.
You got that too. So Mark, why don't you press the button to end the program? And once we end the program, then we'll answer